back testing last week's Monday. Now, I didn't get a chance to trade this entire last week because I had a lot of things going on, but today we'll be going over how I would have traded if I was on the charts. Now, granted, I was checking the charts while I was doing everything that I was doing, and it didn't really look too promising in the first place anyway, so I probably wouldn't even have traded the majority of the days that I didn't trade anyway. So moving in, right, moving into your Monday, you always want to mark out the new week opening gap, which is going to be right here. So the new week opening gap is going to be where price left off or where price kept going from. So we can see right here that market open was right here at 181 for that new week opening gap. So 20,181. This is going to act as a level of resistance. Okay, so this is going to act as a very important level because price is going to want to likely tap back into it. It's just something that I've learned from back testing and from what a friend told me to back test. I back tested it and I went ahead and found out how important it actually is. So with this level marked out, I'm going to be teaching you guys about MSSs, right? Market structure shift plus DOL sweep plus IFEGs. So this is how to execute trades after liquidity has been swept. Now, it can't just be any liquidity. It has to be internal liquidity. Okay, so internal liquidity is going to be like this Asia and London high. Okay, so Asia and London. These are internals, right? So let's say right here, we're getting on what, 4:45. Let's go and just pop through to, what is it, 6:30. Yeah. So we'll go ahead and pop it to 6:30. Right here. So we'll pop up at 6:30 and then we'll find out how price wanted to go. So as we can see, London already took out this Asia low right here. Okay, so this is the Asia low, and then this is the London low. Okay, so as we can see, London already took out the Asia low, and then price, before New York AM even started, had already taken out that London low. Now, since we have the internal draws on liquidity taken out, we can expect price to open up bullish. Now, doesn't always happen, right? This is where you have to play according to what the market is giving you. It's not about necessarily predicting everything that's going to happen. It's just the most likely, the most probable thing that's going to happen, right? So let's go ahead and move forward. Let's go ahead and play this piece by piece. And we'll pause here. So right here where we paused, we can see right here right away, London and Asia already got taken out. Okay, so this London and Asia high got taken out right here on this candle right here at the 7 o'clock. So right here, we're looking at price go ahead and take out London and Asia high. Now, the internal DOLs have been taken out. Okay, so these are very important pools of liquidity. But we do also have this new week opening gap right here at 181 marked out. So let's keep an eye on price and let's see what price wants to do, right? So if we can break above this New York AM high that took out the Asia high, then we can pretty much expect price to continue to move up into that new week opening gap. Now, it doesn't always happen on the first day. It could happen 2 weeks later. It could happen the same day. It could happen 5 days later. It could happen however it wants to happen, but it's going to act as a very important level of liquidity. So let's go ahead and play this out and let's see where we're going to go from here. So price is going to toy around and then make its way up. Right, so right here, right off the bat, let's pause right there. We can see that price at New York lunch went ahead and took out that level right here that we had opened up at New York AM highs up here. So after New York lunch went ahead and took out that New York AM high, we can see that there was, now you could use this for a continuation model, but I would have actually not taken a continuation model because our level of liquidity is at 181. And if we seen that price went ahead and broke out this New York AM high, let's go ahead and delete these levels. We don't need them anymore, right? So now that we know that these levels got taken out by New York AM highs, we can see that price is going to push up. Now the question is price going to push up and break past this level of liquidity, or is it going to reject? Right, so in this instance, I would have probably waited to see what price would have wanted to do. So as we can see, also doing a little bit of review, there's no real entries to take here at all. Right, we have no we have no fair value gaps that we can take retracing into this level of liquidity. So there's no way that we could even take a continuation model. We have no fair value gaps to take out. We had a break of the structure right here at the New York AM highs, which continued going into what this level is, but we have no way to enter, right? So we wouldn't want to force a trade. Even if we know that price is going to go ahead and try and tap into that level, there's no reason why we should look to enter, right? So let's go ahead and keep going. And we can see that price went ahead and tapped that, right? Let's go ahead and pause. It just kept jumping. So, right, I mean, I went a little bit fast, so I'll go ahead and reduce it, but let's go a little bit more back. Boom. So, price went ahead and tapped into this new week opening gap and started to reject, right? So this is where we can expect to see the MSS form, right? Let's see. So this is going to be the market structure shift, which stands for MSS, right? And then we'll go ahead and point down to it. Damn, that's terrible. Okay, so this is the MSS right there, market structure shift, right? The market structure shift is going to begin to occur after the draw on liquidity sweep, right? So this is where liquidity, this resting pool of liquidity right here, where this new week opening gap was, this is where we can see the sweep occur, right? So we see this draw on liquidity sweep occur, right? So now we have pretty much the bread and butter of an MSS plus DOL sweep plus inverse fair value gap, right? So this is where we're going to look to see what price would have wanted to do after it took out this very important level. Now, as you can see, price just started dumping, right? So in this instance, right, as this is building up, before this even comes out, before this entire MSS starts to form, I'd look to see where my IFVGs could be taken, right? So automatically I can see right here that we have a small but valid fair value gap right in between these two levels, right? So this is going to be my bearish fair value gap, right? I mean bullish fair value gap. Apologies. So using this right before this even would have came out, right? Now, as we see that price takes out this draw on liquidity, and I'll go ahead and take all this stuff out. Right, as we can see price start to take out this draw on liquidity, we can see that it's going to start to inverse. Okay, now this is where I start to look for a short position right here. We'll go ahead and pause. Right, we'll go ahead and go for a usual 25-point stop loss, or what I like to do is go ahead and place my stop loss right before or right after the other candle, right? So in case we get a rejection going back up, we should look to see, especially with 25-point stop losses, we should look to see if price is going to break above the previous low. I mean, the previous high, forgive me, because we're looking for shorts. So my levels that I target would simply be here, right? These new levels that we took out. Okay, so go ahead and take this out, and form our new levels of liquidity. Here we go. So these are going to be our new levels. Now, right, assuming that we'd enter, right, after we see the MSS start to form, after the DOL sweep, right, we're going to go ahead and enter our usual 4 cons. Slow down a little bit, and then we'll go ahead and go based off of what I would have seen on the charts. So this would have been my setup, right? I would have looked to see if this fair value gap would have gotten respected, and I would have attempted to take it, right? So off rip, right, we can see with this kind of selling pressure, I would have definitely wanted to take shorts, right? After we have the DOL sweep from the new week opening gap, right? All the DOL that we had already taken up here, right? All the internal DOL that we had taken out in here on these London and Asia highs, I would have definitely looked to take some shorts. So let's go back, and then let's see if I can get filled back to where I wanted to get filled. So we're going to go ahead and go shorts once we can see this selling pressure occur. That's it. That's going to be our TP. Sorry, that's going to be our entry, and then we are going to look for here for our TP. Right, so as you can see, right, price went ahead and dumped down into where our TP is going. Now, would I have wanted to take my TP all the way down to New York AM highs? Not necessarily, right? Because this is where you have to look at the time frame alignment, right? In this instance, we can see that we are forming what looks to be another MSS down here. As you can see, there's higher highs here, higher lows, higher highs, higher lows, higher highs, some kind of MSS retracing down into this DOL down here, right? We can see that price starts to go ahead and chop up a little bit here on the higher time frame, and then we can see a new trend start to occur, right? Again, there's accumulation down here on the higher time frame, accumulation, and then a break of structure over here going into highs. So that's where you have to really kind of be careful on like time alignment and knowing kind of what kind of trend that you're going to be in, right? You don't want to be stuck in a trend that is against your bias, right? This is why time frame alignment is really important. So before you enter your trades, you have to look at the time frame alignment. Now, move forward, we'll go ahead and continue. See what happens if we move our TP down to these New York AM lows. The hottest shit. And we ended up having 4 minis instead of 4 micros because we are in NQ1. So I'll just leave it at one mini. Right. So again, we're gonna be testing this this strategy out and seeing how it can help you make money. So let's go ahead and see where our entry would have been. There. So right here is where we would have looked to take our entry. So we'll take one sell position, put our stop loss at 25 points, and then we'll take our TP down just to be safe. I mean, if we're just going to play it safe, I wouldn't really look to target this New York AM low, even though it's a very strong level of liquidity. I'd look to just take out this New York lunch and take some quick profits there. So let's go ahead and enter this position. Let's play it out. Go ahead and increase the speed to 0.5. And you see that there's that pullback right there. So this is that pullback that I was talking about, right? With everything in every market, there's going to be pullbacks, no matter what you're going to take. If you're taking shorts, if you're taking longs, left, right, up, down, vertical, it doesn't matter which way you think it's going to go. There's always going to be pullbacks, right? And those are going to be those draws on liquidity that we're going to be looking to take, right? So with this being said, our TP would have already been taken out. So right here at about 56 points is what would have been our TP. So as you can see right here, our risk reward ratio would have been 2.27, right? And if you went ahead and just filled in with just 1 mini or 10 micros or 5 micros or whatever your normal sizing is, you could look to take a piece of the pie. And that's why it's really important that you understand that it's not always going to go down to where your TP or where your whole bias is, right? My whole bias would have been down here at this New York AM low, right? If this MSS formed correctly, like how I think it did, then it would go ahead and target this New York AM low. But it doesn't always have to do that, right? So let's go ahead and see how this would have played out. Oh, that would have been mean. Boom. So look, right here, this is a new day opening gap. So as you can see right here, this is 2 o'clock. Price would have opened up at, 2 o'clock, and price would have opened up at 3 o'clock. Yeah, there you go. I don't know why I had to bring forward. But yeah, so before this even came out, before this new day opening gap, which is actually really just a new trading day, right? Because the market closes temporary. The market's open, right? For futures, the market's going to be open 23 hours a day, right? With the exception of 2 to 3 p.m. Pacific Standard Time. That would translate to about 5 to 6 p.m. Eastern Standard Time for everybody watching on the East Coast. Right. So let's say we went ahead and took profits somewhere around here, right before the gap. We would have been looking at a really nice chunk of the pie, right? This would have been about 4 to 1 risk to reward, right? If you're going ahead and using 1 mini to target your take profit, you would have been up a considerable amount, right? So this is how you trade MSSs, right? You look to see where the DOL sweep is going to happen. You look for any lingering factors. You want to make sure that the time alignment is correct too, so that way you don't have the incorrect bias. Um, and yeah, very short, very simple, right? It's really important to mark out your levels. Like I just said, know where your time alignments are, right? So if you're going to go ahead and trade on the 5 minute like I am, you want to go ahead and use the 1 hour as your time alignment. Understand what the bias is, see what the market wants to do. Wait till you see what the market wants to do, and then you execute your trade, right? So this is going to be an MSS trade, right? A market structure shift. We took out the draw on liquidity. We went ahead and took out all the important internal DOLs, right? The London and Asia DOL over here, where this New York AM started. We went ahead and saw that price confirmed it was bullish until it reached the new week opening gap, right? It targeted that liquidity and then inversed completely. So very simple, very short, and very sweet. So yeah.